Everyone, welcome to Blue Dragon Actual. Now, initially, I was thinking of doing a participating policy masterclass, but I recognize that there are 3 chapters in SA2 regarding participating policies, and also there are a lot of mentions about participating policies here and there. It's a difficult concept because there is a lot of judgment involved, and it is difficult to kind of visualize, right? So until and unless we go through the non-participating policies in like kind of extreme detail, which we already have in a way, that's why I thought participating policies can be taken up now. But I think there is something more left. And also the length of that video would be around 2 hours, I believe. And I mean, because the exams are going on, it would be, I don't think anyone would be kind of interested in seeing a 2-hour video and like a very important concept which people would otherwise enjoy. But that would not get into many people because of the exam and the conditions that we are in. So what I decided to do is to do another very important topic, which is called analysis of surplus. Participating policies will take up in August after the exams are over. So however, analysis of surplus is equally important. I think if you understand analysis of surplus, if you have done analysis of surplus in your life once, then you understand every bit that is there in life insurance, because otherwise you cannot do analysis of surplus. Like there will be a huge unexplained. You have to know how the reserves are moving. You have to know what are the components, and your concepts gets thoroughly cleared if you have done analysis of surplus. So today's topic would be analysis of surplus, and we'll move on without further delay. So the first point is what exactly analysis of surplus does, and why is it called analysis of surplus. So in order to understand that, we have to see that analysis of surplus is sometime is not sometime, it's actually related to the experience stage. So it's related to the experience analysis. So in experience studies, what we do is we analyze the assumption, we see if it is changing over a period of time. If it is changing, if we are expected to change it for the long term, then we kind of change those assumptions, right? Now that's how an analysis of surplus kind of is one of the main component there. We try to see why, how the analysis surplus is changing and how everything is happening, and then we need to kind of monitor it for maybe say 1-2 years. And if we think that's a long-term thing, it is going to impact our assumption, then we need to revise our assumption. A very simple example would be COVID, right? Because of COVID, there might be increase in the morbidity rate. Now we can wait for it for say 1 year or 2 year, and say after 2 years we see that this thing is going to stay there. It is going to increase in the future. So might be our earlier assumption was say 20%. Now it increases it to 25%, right? Because we have seen the past, we have kind of seen it in the present, and in the future it is based on the past and present, it is expected to increase. So that's why you change it. So analysis of surplus kind of help in doing that. Now, first of all, we have to understand what is surplus actually. Now, this is a term that we don't use regularly. Like we use profit or loss. So surplus means the same thing. So this is a simple example. Suppose at the start of a particular year, you have an asset of 200 rupees, say, and liability of 150 rupees. So then asset minus liability would be your capital. Now, this is not profit. Why do this is not profit? Many people would say asset minus liability is profit. That is not profit. Profit is given by change in asset and change in liability, which you'll see here. But this is capital, right? Asset at a particular asset is a particular point of time. Liability is at a particular point of time. So these are balance sheet item. And when you subtract asset minus liability, is the equity or the capital. And we have that, if you remember from CT2 or whatever that subject is called, maybe CB2, or CB1, I don't remember. It is asset equal to equity plus liability. That is the balance sheet equation, right? So this is what we are kind of talking about. Now in life insurance, because of the way the risk is kind of structured, is a long-term business, right? The profit will come at a later stage. Now that later stage, because of that, we have to kind of expect the profit. We have to kind of do the projection. So because of that, we need capital, right? Because there is uncertainty involved. So 200 minus 150 is 50, which is the available capital. That is the capital that the life insurance company have. But within that, because of the uncertainty, it needs to keep some capital to kind of deal with such uncertainties, like COVID, like once in a thousand in a year scenario, a war like the Russia-Ukraine war that kind of break out this year. So that, and there are different ways company can calculate that. We have already gone through the economic capital concept in our capital management sort of videos, right? Stress capital and unstressed capital, take the difference. So we have gone through that. We have also seen the factor based method in our ALSM video. So here I've taken a simple example of factor based method. So here what I've done is liability is 150. 3% of the liability would be required capital, right? It can be different. It can be based on sum at risk. It can be based on reserve. I have just make an assumption here. So if you see the solvency ratio, which is basically the ratio of available capital and the required capital, that is coming out to be as, so yeah, that is coming out to be 11 I mean 11,000 1100%, right? That is way high. In India it is 150% is kind of required. So because of this kind of silly assumption, we are getting that. But this is the basic structure that one needs to understand. Available capital 50, required capital based on factor method. So we have used a factor and we got this. So now this is the solvency ratio. This is how the balance sheet, or that the balance sheet liability, that is the section this kind of implies to. Or but if you consider the PNL is more about change in asset and change in liability. So although the asset at the start of the year is 200, the asset changed or increased by 40, right? So asset increased by 40 rupees and the liability increased by 20 rupees. So this 200 has now become 240 and this 150 has now become 270, right? So then the profit would be the difference between change in asset and change in liability. That is why profit or the PNL statement is for the period. It is not at a particular date as asset is or liabilities. It is for the period. And that's why this is the surplus arising, which is 20 in this case. That is basically 40 minus 20. Now, suppose in the next year, year two. So now what is your asset is 240 rupees at the end of year one, and your liability is 170 rupees. Now your asset has increased by further 15 rupees. So it becomes 255 and your liability has reduced by 10 rupees, right? So your liability instead of 170 now is 160. So what is the difference between change in asset and change in liability? 15 minus minus 10, which is 25, right? So you got 25 rupees profit. So the movement from this to this 20 to 25, this 20 to 25, this bridging is what we call analysis of surplus. So we would try to find what has caused this, what are the buckets in which we can split it. Now, what would be the bucket in which can influence a profit or loss? That would be new business, right? All the transactions. Like if you consider the company as a book, financial ledger, then something will come into the company, something will go out from the company, right? So those would be the reason for surplus, right? So that is the first. Those would be the one of the reasons for the surplus. So your new business has come in, right? And because of depending on the way the new business is kind of written, whether it's written on best estimate basis or prudent basis, it might or might not have initial strain. So because of that, new business would impact the surplus. Then there would be death and lapses, right? And then there would be maybe policies becoming paid up. So all of this would contribute to the surplus. Suppose you are assuming 10% death in a year and you have got 20% death. So obviously what you have expected and what you have paid out are different. So you expected was far lesser, but your paid out, what you have paid out is much more. And because of that difference, there would be a loss, right? Same goes for lapse rate, right? You have expected 10% policies to lapse and you have got 20% policies to lapse. Now in the lapse rate, there is an additional consideration at which duration this lapse is happening. So if the lapse is happening at an earlier stage, it might result in loss. If the lapse is happening at a later stage, and especially for protection environment policies, protection type policies where there is some lapse supportiveness, it might be good for the company. So depending on the duration, so what we can see is surplus is arising because of the difference between expected and actual. So at the start of the year, we have some expectation, and if that expectation is met, then we come at with no profit or no loss. But if that expectation is not met, and if that expectation is surpassed, then we come out with profit. However, if the expectation is not surpassed, if the expectation is or surpassed in the negative direction, then we come up with loss. So that is how life insurance companies behaves, and that is because of the long-term nature of the life insurance. So we have to kind of do the projection, right? What we mentioned, what I mentioned here, required capital. There is an uncertainty involved, so we have to do the projection, and because we have to do the projection, there is assumptions that is required. Like If you need to calculate your salary maybe 10 years down the line, you need to have an assumption about the inflation. You need to have an assumption about the growth rate of the salary, right? So otherwise you cannot project your salary. You need to have an assumption. Same goes for life insurance. Mortality, we need to have an assumption. Lapse, we need to have an assumption. Expense, we need to have an assumption, right? And these are the predominant the predominant assumptions. So if you go to any actual software like Axis or Profit, you will see this assumptions: mortality, lapse, expense, and interest. These are the four main assumptions. Obviously, along with that, there might be some other assumption. There might be reinsurance. There might be the way you calculate the decrements, whether you calculate the start of the year or the end of the year, right? So there might be some other small things, but the main assumptions would be mortality, lapse, expense, and interest rate, right? These are the main assumptions. So the entire analysis of surplus chapter is kind of centered around this assumptions and whether there is a difference between expected and actual. And if you have kind of studied CP1, probably have got a flavor of this earlier. So now moving on. So what is analysis of surplus? Analysis of surplus provide reconciliation between the start of the year and the end of the year supervisory surplus. We have already seen that, right? And this surplus is actually called surplus arising, right? When we are kind of saying surplus, we have to kind of reconcile back to our original definition that we use for profit, right? That is called profit. There is no difference between profit and surplus. This can be used interchangeably. So that's that's it is called surplus arising, but instead of, you can see this surplus arising, but instead of calling it surplus arising, we are, I mean, the industry norm is to call it surplus, right? So that's why we call it analysis of surplus. Otherwise, the proper term would be surplus arising. And as I mentioned, if you have studied CP1, you have kind of gone through this. Now, outline the reason why an insurance company may want to perform an analysis of surplus, right? And if you have once again gone through CP1, there is an acronym called divergence, right? And divergence would capture all this point, but nevertheless, we would go through this point and we'll see that all these points are kind of what we have already covered. So show the financial effect or difference between the valuation assumption and actual assumption. So valuation assumption means the expected assumption because you are kind of projecting, right? The salary example that I give and the actual experience. So I think that this would be clear to determine the assumption that are most finally significant. So you see every year there is more difference in the mortality surplus or in the lapse surplus. Then that means that the pricing is not done proper, right? Then the assumption needs to change. So that is it kind of identifies the most important decision. Then shows the financial effect of writing new business, which I told, anything that transact with the company, right? New businesses flow in or come in inwards movement towards the company, and death and lapse would be the outward movement. Then validate the calculation assumption used. Obviously, I mean, if you see last year mortality surplus was say 100 rupees, and this year the mortality surplus coming out to 500 rupees, then there might be some error that has happened in the profit calculation or something, right? So validate the calculation assumption is provide a check on data. So initially, when we do the analysis of surplus, we have to kind of track this movement, like how many of the policies would be death, lapse, new business, paid up, etc., not taken up. So there are a number of statuses, and so that kind of, so you do it. So there should be two source. One, the actual department will maintain, and there will be a data from IT. They will maintain and they will have their own classification. So we will try to reconcile with this, and we'll see that there is a difference coming out. Say as per IT data, there is 10 deaths that are supposed to happen, and as per your data, 12 deaths has happened. So where this 12 that needs to be fitted in, whether it is captured in IT data. Usually the problems happen in the not taken up policies. So there are some policies which are kind of not taken up by the company. They have came into the company, but they were not taken up because of some other thing, maybe substandard or something. And those policies might be kind of captured in death or lapse somehow, right? Because of some error, and that might be causing the issue. So we have to kind of, first of all, we have to kind of determine what is the number of policies that we should consider, and if there are some policies that we need to remove, because otherwise it will never match. Suppose there are 20 policies that we need to remove from the extract, and if we have not removed that, then the profit will produce the reserve for that, because those are enforced policies, right? And it will never match. There is also a challenge with the revival, suppose a policy, because in life insurance there is a revival term, especially in India, there is a revival term of 5 years. Now suppose a policy got lapsed 2 years back, and then the policyholder decided, so policyholder was not contactable, the policyholder was kind of forgot about making the payment. uh, he or she changed his mobile number, and then that person was never reminded and completely forgot about the reinsurance payment. And after 3 years down the line, someone was able to contact that person, and that person decided to revive the policy. What will happen then is that the policy would be revived. Now suddenly at the start of the year that policy would not be there, but suddenly in one of the quarter that policy would be in the book, right? So there would be a mismatch. Now the when you kind of calculate the reserve for at the end of the year, that policy would contribute to the reserve, but that policy would not contribute to the reserve at the start of the year, right? But that policy is also not new business. So any criteria that you use to filter the new business, like what are the policies that are issued in this year, that policy will not fit that criteria. So that policy, so you'll not be able to segregate it in bucket. Like you will start with the maybe the start of the reserve is 100 rupees. The new business we expect to be say 20 rupees. So you expect that 100 plus 20, 120 should be the end of the year reserve. But in this case, you will get 150, and you had no idea why this you are getting 150, because you have done everything correct. The prior period reserve is there, the new business reserve is there, and the current period reserve is there. There is no other transaction. Suppose there is no death, no lapse, no surrender, etc. So then why is not matching? That is because of the revived policies. The policies have been revived, and they will not fit the criteria for new business because they were issued earlier. And what our expectation is, because if it is issued earlier, it should be in the prior period, but because they are lapsed, they are also not in the prior period. So that will cause the mismatch. Okay, so moving on. So identifying non-recurring or components of surplus. Obviously, if some surplus has not happened in the previous year, and this year there is a surplus, maybe in reinsurance. Right? So then that might be reason. Reconcile the value for successive years, as a given example, that mortality surplus would probably be in the same range. Right? If it is not in the same range, then we have to kind of see why it is not. Provide management information. Obviously, use data for executive remuneration scheme. The more the profit, the more you will get. Like there is a bonus component, right? We all know there is a fixed CTC and variable CTC. So the more the profit we make, the more bonus that we get. Demonstrate the variance for individual sources is a source of total variance. So when the example that I was kind of just giving, that if you expect there are 5 sources where there would be a difference between actual and expected, that individual source would match up to the total variance, right? And there obviously it doesn't happen like that. There may be rounding of error. The profit version might change. Something might happen, right? So there will always be some unexplained thing. But if it is within the tolerance level of the company, then it is good. But if it is not within the tolerance level of the company, then there is a issue, right? So the ideal expectation is that all the individual source of divergence should come out and should match with exactly the total variance. And most importantly, give information on trends and experience to feedback into the actual control cycle, right? We have already kind of covered that. Now, source of surplus. Now, when we kind of go to the source of surplus, I have already mentioned all these assumptions: mortality, lapse, expense, interest. All these assumptions contribute to the source of surplus, right? Now, when we kind of see this source of surplus, it can be split into 2 parts. So, suppose your mortality rate at the start of the year is 1%, right? That's where you started your kind of year, and then you expect the mortality rate to change to 5%, right? That is your expectation. So there will be a movement from 1% to 5%, that as per your expectation. However, what happened was mortality rate changed to 6%. So one can say that the mortality rate has moved from 1% at the start of the year to the 6%, right? But another person can say the mortality rate has moved from 1% to 5% and then from 5% to 6%, right? It can also happen that it moved, your expectation was 4%. So you'll say that the mortality, your expectation was 5%, but actually it has turned out to be 4%. So what will happen, that one can say that mortality rate has moved from 1% to 5%, and then from 5% it has moved to 4%, right? It is not necessary that it has to be increased in an increasing order. So we now obviously both this kind of capture the same divergence, 1% to ultimately you need to move from 1% to 6%. But I think because of providing more information, more transparency, if you can capture the movement from 1% to 5%, which is the expected movement, right? This is what you are expecting, and then you capture the actual difference between expected and actual, which is 5% to 6%, that 1% gap, then it is more transparent, right? Then what you are kind of projecting to the management, that we have already considered that there will be a change in 5%, right? We are that much accurate. We are already off by our assumption, from our assumption by 1%, right? Otherwise, if you don't provide this information to the management, you are saying you are moving from 1% to 6%. Management did not know whether you are doing a good job of predicting or not, right? So that's why you need to give more transparent information, and every assumption can be kind of split into that. So first of all, you start with the current period, I mean the prior period assumption, right? And then you move to the expected assumption. So there will be an expected assumption change. Maybe that assumption change happens in the third quarter of the year, or maybe that assumption change happens in the second quarter of the year. Maybe the assumption change happens differently. Maybe the mortality assumption change happened in the second quarter, and last assumption change happens in the third quarter, right? So it might happen like that, but you have an expectation that the assumption will change. But eventually over the year, you saw that the assumption has changed slightly differently from your expectation. So that difference has also needs to be captured. So the more the number of buckets we can split in, the more it is better. So usually there would be this buckets. First would be the new business, as I mentioned. Then there would be a change in the assumptions. So assumption change once can also be split into the expected assumptions change and the actual assumption change, right? The actual assumption change also called experience adjustment, because your transaction has changed, right? So that is called experience adjustment. So if then experience adjustment, then assumption change. Assumption change can also split into economic and non-economic, or insurance and economic. Economic are those which kind of influence the economy, which are outside the control of the insurer, like inflation, interest rate. Insurer cannot control this, but it depends on the economy, right? And mortality, lapse, etc. I mean, there is a way insurer can contain this because of good underwriting or reinsurance, or by having a team to kind of control the lapses. So that's how insurer can control this, right? And finally, I mean, there would be obviously some unexplained component, but ideally there should not be any unexplained component. So maybe it can be, and there is one component which we call unwind. So unwind means everything remaining same. If the interest rate, what amount of reserve would be released because of change in the interest rate. Suppose you are saying that at the start of the year, your liability is better to show by an example. So suppose this is your expectation. This is say Y1, year one, and this is year two. Okay, and you have say liability expected, and currently you are at year zero, at the end of the year zero. Okay, now this is 50 and say this is 20, right? And you are expecting a discount rate of say 4%, right? So you are expecting a discount rate of 4%. Now if you have to calculate the liability here, what that liability would be this would be 50, right? This is in 1 year, so divided by 1 plus this plus this one, 20, divided by, I have to give two bracket, which is 1 plus this to the power 2, right? Because it is being discounted for 2 years, right? So this is the liability. Now suppose so what happens if nothing changes, right? Suppose you are at the end of year one now, and if nothing changes, so the liability would change, right? So what would be the liability? Liability would be now this, right? So what is happening is, let me check if it is P2 Q5. Yeah, P5 is kind of this is discounted back. So this is the, nothing has changed, the discount rate has not changed. So this is the current at the end of year one. This is the liability. So unwind, or the reserve that would be released. So earlier it was, you are kind of holding this amount of reserve, right? 66 rupees of reserve. Now at the end of year one, assuming that nothing has changed, discount rate remaining same, you are only holding 29 paisa, right? So this release of reserve is what we call unwind. That happens because of the discounting, right? Because of discounting, the time value of money is kind of it gets released over a period of time, right? So this would be the this will be the unwind. 266 minus 29. So this is the unwind. I think I can write somewhere here. Put it in red, right? So this is the unwind. So initially you start here, then you go here, and because of that you are kind of getting some of the reserve is getting released just because of the time value, just because of the time value factor, right? Nothing else has changed. It's just the time value, and because of that, this is the unwind. So that there would be a unwind because you have an expected rate, and if nothing has changed, you will kind of get some results. That is also that is also part of the economic assumption change, right? So it can be split into unwind and the difference between expected and actual. The economic assumption can be split into that. So yeah, just wanted to kind of call that out. So obviously, so source of surplus first would be the opening adjustment. So suppose your profit version has changed, the coding has changed within the property, you cannot do anything about that, or GGY access coding has changed. Earlier you are using some 2021 24, now you are using 2021 30, right? The version has changed. Because of the version change, there would be a minor impact, because of there are some coding changes which you cannot do anything about, because the company which is kind of producing profit or producing GGY access, they have changed it. So because of that, there might be opening adjustment change, or there might be a case that you have made an error earlier that was not been caught, or there might be a regulatory change that has to be kind of reflected, and because of that you have made some coding changes. So the prior period, I mean the reserve or the profit at the earlier period, which is the previous quarter, will not tally up with this quarter, this quarter start, right? So because of that, there would be an opening adjustment. So that is what is been called out here. Return on opening surplus is the unwind that we have kind of seen there. And here you will see that at the end of the suppose over the course of the year, suppose the actual return is 1% and expected return is 0.5%, right? So at the end of the year, the balance sheet asset would have increased by 1%, which is 2222, and liabilities have increased by 5%. So liabilities will also always increase by the valuation assumption, because that's why, right? We know that reserve is our liability, and liability will only change by the expected thing. Is the asset which kind of take care of the the actual part. And as I mentioned, I've repeatedly time and again I've mentioned that in life insurance there is no such thing as liability. There is no physical existence of it. It is only mathematical reserves. I've repeated that point n number of times in the LSM regulation. So you can go to my LSM regulation video if you want to understand that in more detail. What do we mean by mathematical reserve, right? So mathematical reserve is our liability. So here you see that the end of the year surplus is 212. So your valuation, so your liabilities increased by the expected rate, which was 5%, and your asset has increased by the actual rate, which was 1%. So earlier it was 200. So at the start of the year, the asset was 2200, liabilities were 2000. So the start of the year surplus was 100. Kind of here, if you go back to my example, it is kind of saying this 50. However, what they have written is asset as 2200, liabilities as 2000. This is not correct statement. It should be change in asset and change in liability. However, just for the sake of simplicity, they have written it. However, I have written the correct definition here. Profit is given by change in asset and change in liability, right? So just assume that this is change in asset and change in liability. So change in asset was 2200, change in liability is 2000, and at the start of the year surplus is 200. Right now, then the asset increased by 1%, which becomes 2222, and the liabilities only increased by expected rate, which become 2000, and now it has become 212. So from 200 it has moved to 212, right? So this is the analysis of surplus. How can you bucket this 12, right, into different segment? So here you see is 212 minus 200, which is 12, right? And this is the this 12 need to be bucketed into different factors. So in this case, there is only change in the discount rate, right? So the company may choose to present this 2% as actual return on ongoing surplus. So as I mentioned, your mortality was 1%, it changed to 6%. You can show the movement from 1% to 6%, but you can also split it between 1% to 5% and 5% to 6%. So that's what they are, and that is more transparent. That shows that you are able to, as an actuary, you are able to predict it more accurately, right? So the company may choose to present this two as actual return on opening surplus, and 10 would be the difference between actual and expected. Right. Alternately, the company may choose to present this as one, right? One, and so is basically is just you start with 2000 and multiply that 2000 with 0.5%, and you'll get that get that one, and remaining would be the difference between the actual and expected. Or in this case, you start with the 2000, multiply it at with the 1%, which is the actual return, you'll get the two, and remaining would be the difference between expected actual. So here you can see it's kind of splitting. So they are kind of trying to in this case, one is the unwind that we have just spoken about, and 11 would be the difference between actual and expected, right? So that's how you can split the economic variance. Now, obviously, economic variance result from difference between actual expected. I think right by this time it is probably ingrained in you what we mean by economic variance. So, and it shows the difference between actual expected. So, in economic variance is what we call economic variance is the investment and inflation currency exchange rate. So, I have already mentioned about investment and inflation currency exchange was kind of missed. An economic variance item will include the mismatched profit. So, if you remember our asset liability management, so the insurance company always tries to mismatch a bit because that will generate in profit. But obviously there is a loss probability there. There is a risk there that it might result in loss, which is kind of written here. So if it is perfectly matched, then the insurance company will never incur any profit or loss, right? At every point of time, whatever would be the liability, the asset will produce exactly that amount, and there is no profit and loss. But it's impossible to do it in practical scenario, right? So obviously you can change your asset mix, right? And especially that can happen in with profit business because there is a lot of discretion involved. So if there is a financial guarantee, right? So this needs to be separated, and these are also source of surplus. If there is a financial guarantee, depending there may be symmetry of risk, and there may be non-symmetry of risk. So because of that, there might be a there might be a difference. So here you can see an example. So I imagine that a company has block of business on which it has regulatory approval to applying a matching adjustment. At the start of the year, the gross redemption yield on the company's matching assets is 2.5%. So we already know what is matching adjustment. Matching adjustment is if you are holding annuity, because in annuity there is no surrender. So there is no surrender risk, right? So whatever asset you are holding, you can hold it for the entire duration. If you suppose you get a corporate bond, otherwise corporate bond has more risk because there is more default risk. But because corporate bond gives higher yield, then you can probably and because in annuity there is no surrender, so you can use that higher yield. So your that extra yield that you get over the government bond is called the matching adjustment. It's only possible in annuity. Otherwise you need to kind of uh, match it with the because there is surrender value involved. So that's why matching adjustment not be applicable. So that is the matching adjustment. So the gross redemption yield on the company's matching assets is 2.5%. The risk rate is 5%, right? And the spread, fundamental spread is 0.3%. So this is that CAPM model, 0.5%, which is the risk free rate, and then 2%, which is the market kind of market premium or market rate. I mean the extra risk or the extra return. Then which is kind of subtracted from 0.3%, which is the spread. So market premium minus the spread. Spread is usually for the default risk, so we get that 2.2%. If the asset earned more than 2.2%, then investment surplus will emerge over the year. In particular, if they achieve 2.5% and there are no defaults, then 0.3% of extra yield will give rise to variance, reflecting the difference between company's actual experience, and 3% would be credit risk for the fundamental spread. And so I think you can understand what we have done, and there are several adjustments that we can do. All of this adjustment, like matching adjustment, there is a volatility adjustment. And so all of this adjustment can cause a difference. Why? Because your asset is not kind of incorporating that adjustment. You are not applying asset say volatility adjustment or matching adjustment to your asset, but you are applying that to your liability. So if that volatility adjustment changes, your liability value will change, right? But your asset value would not change because that was never the part of the asset, right? And because of that, there will be difference. So that's exactly has been called out here. And obviously it can be split into expected and actual. We have already covered that, right? So I think these are so non-economic variance we have already covered. Expected, which is the demographic assumptions, mortality expense labs. We have already covered this. So there and even after all of this, there might be unexplained, and then unexplained needs to be captured. So I think we see the theoretical portion of it, right? Now we see the process. So at the start of each year, rerun your valuation model, right? Just run your profit. So you earlier you have the profit and loss, the earlier year profit and loss, earlier year end of your profit or loss. Suppose it is 200, or in our example, in this Excel example, it was 20 rupees, and next year it is 25 rupees. So you are right now, you are at this point at the end of year two, right? You know this, you have this figure 25, and you obviously have this figure because you are at the end of this year. So you have this figure and this figure. So surplus arising is movement from here to here, right? So you make any opening adjustment, as I mentioned, in regulatory change, any version change, any change in coding, etc. Made that and run with the adjusted model with non-economic assumption to obtain the impact of the assessment for the assumption changes. Then you change it one by one. You change, suppose at the initially you start with the prior period model, right? Then and in the prior period model, you kind of get the result profit and loss. Then you switch on to the this period model, right? And then you start run the model. Ideally, your expectation will be the profit and loss would match. If there is some mismatch, then there should be a reason for that. That should be documented. That would be your opening adjustment, right? Then you move on to the assumption bit. Then you change your modality assumption. Then you change your lapse assumption, change your expense assumption. So, and you do it one by one. First, you change your modality assumption, you calculate the reserve. So that will only have the impact of change modality assumption. You kind of take the difference between the reserve of the previous step and this step. It will only give you the impact for the modality, right? Then you change it to then you change the lapse assumption and change that take the difference of the reserve from modality step to the lapse step. It will only give you the impact of lapse. In this way, you can do it for the expense, etc. So this will give you the expected difference, right? This is the expect, because you are changing the valuation assumption only. So this will, it's a difference between expected. Then you will come to the adjustment part, right, which is experience adjustment part, which is the where the transaction would come into picture. So then we'll find out how much the the actual rate is, and that then there you can take the difference, and there you get the actual expected to actual difference. You will see the same thing. So run the adjust model with the new economic assumption to obtain the impact on the surplus from the assumption changes. Roll forward the model to the new valuation date with actual investment, and see the experience just experience part came actual part, right? Add new business written in this interim period. So new business would either reduce the asset or increase the asset depending on how it is written. Adjust the roll forward balance sheet to know the difference between actual and expected. And finally, adjust the roll forward balance sheet for some capital injection or tax changes, right? If there is any capital injection, tax changes, with ideally there would not be some change like that. And finally, there would be an unexplained. You need to kind of reduce, but it might also be possible that you have made some calculation mistake in the asset part, you made some calculation mistake in the liability part, and that's how you get that the unexplained part, and they are offsetting each other. So ideally, unexplained, there should not be any unexplained, but that is not is impossible to get that. Right now, there is a mathematical question, and so I think what I can do is I'll stop the video here because the video is already quite long. So for this mathematical question, I'll post the video on tomorrow, right? And it will just cover this question. So you have to kind of, so whatever we have discussed till now, that will be covered here. And you always have to think from how your asset is going, because your asset is going from the actual perspective, right? And your liability is going from the expected perspective. So you have to kind of see how your asset is going, how your liability is growing, and the difference between that will give you the the surplus, right? So I think this is a very important topic. We have covered the theoretical portion of it along with seeing some small numerical example. Now what we have to cover is to see the the proper the numerical example that is kind of written, which kind of brings all this theory together. So yes, see you tomorrow, and please like, share, and subscribe if you enjoy this content, and if you are able to become a better actuary by this, and provide any feedback if you want me to change anything. I already have an announcement video which will be uploaded on Monday at 9 o'clock, 9 a.m. Right, so you go through that announcement, and that's a very small video, 2-minute announcement. So there will be a change in the pattern that I will be following. And yeah, provide any feedback. Yeah, see you in future. Like, share, and subscribe. Hit the bell icon, and see you in future videos. Thanks for watching.